SVB, Silicon Valley Bank, is one of the most prominent banks in the startup ecosystem. Its collapse over a day and a half is absolutely unprecedented. It all starts with a dollar, and people assume that when you put a dollar in a bank, the bank just holds onto it in some big vault or something, but that's not actually what happened. They need to put that money to work because they want to be able to pay you interest, and they need to make money as a bank. And so the way banks often do this is by buying bonds.
Mr.
Bond. James Bond.
No, not that kind of bond. Bond is just a security from a government, a municipality, or something similar that pays you back over time. Silicon Valley Bank is very similar to other banks in this respect, but they're different because their primary customer is startups. And unlike other banks that get smaller deposits, Silicon Valley Bank gets deposits from startups who get their investment from venture capitalists. And this means that they're getting much larger deposits. So when the pandemic happened, startups had a lot of cash because they went to investors and said, we don't know how long this pandemic is going to last. We need a lot of cash to give us cushion so that we can last, so that our startups can survive, to return money to you, the investors.
Come back in 48 hours with an airtight business plan, a clear go-to-market strategy, and a 3-year summary P&L, or there will be no check.
And so SVB ended up getting a lot of deposits. Early on in the pandemic, startups deposited more money because they had raised and they didn't know how long it would last. They deposited about $198 billion into Silicon Valley Bank. Now, this is good for Silicon Valley Bank, but it also presents a problem because SVB has to create a return on that money. SVB had to find a way to return 1%, or roughly $2 billion at least, in interest to both cover the operations of the company and the interest payment back to the people who had made those large deposits. So normally a bank can buy short-term bonds, but the Fed had cut interest rates almost to zero. It was about 0 or a quarter of a point. And so it wasn't possible for the bank to return that 1 or 2% by buying short-term bonds. They needed to find another way to pay that interest. Now, banks can buy securities and bonds in a couple different ways. They can either buy securities that are available for sale, and this means that they can trade them back and forth on the open market as the price fluctuates. Or they can buy held to maturity. And this really means that these securities are held for the duration of the bond to the end of that bond's life cycle. Even if that price goes up and down, it stays the same price on the books. And that's actually what SVB did. They purchased a lot of hold for maturity securities, a lot of bonds that they planned to hold for 10 years. Now, this in and of itself isn't a problem. They could have held those securities for 10 years and there wouldn't have been a problem. The problem was that as they held those securities, interest rates started to rise. And as interest rates were going up, that meant their book value of the bonds that they were holding long-term started to go down. And this put pressure on them as a company. After all, they're holding these long-term bonds that pay a very small interest rate. And why would you hold on to bonds that have a very low interest rate when there are better bonds out there that pay a higher interest rate? So this was putting downward pricing pressure on the bonds that they were holding. And so the book value of what they had was pretty low. This was compounded by a second problem in that startups weren't raising as much money. In fact, we had a little bit of a venture capital slump where startups were not raising a lot of money. In fact, they were burning through the cash reserves. And so that meant they weren't making deposits into SVB. They were making withdrawals from SVB. So now SVB is getting squeezed. They did have the money, but it was locked away in these long-term bonds. And if they sell those long-term bonds, it'll take a huge financial hit and put additional pressure on them. So SVB decided to take a hit, and they sold about $21 billion of those short-term securities available for sale to give it a little bit of wiggle room, to give it a little bit of liquidity and cash flow to handle some of the withdrawals. But because this caused a loss in some of the value, they needed to raise additional capital to cover their loss. They couldn't have timed this worse because they made their announcement that they were selling those securities and trying to raise additional money for further liquidity at the same time that another bank was going under. And so this created a lot of tension in the venture community because they're like, okay, I see this other bank failing over here. Is there something going on?
Stock's trying to bounce off the lows of the day, but the damage is done, and no stock has been hurt more than SVB Financial Group today. The shares plunging the most in more than 2 decades after the parent of Silicon Valley Bank announcing a stock offering and, well, getting rid of some things that are on its balance sheets. A lot of concern out there right now.
And so a bunch of VCs from Silicon Valley, all across Twitter, all over the ecosystem started to say, don't be the last person to get your money out of SVB.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
And so over the course of 24 hours, about $41 billion was attempted to be transferred out of SVB. And effectively, SVB didn't have the liquidity to even make that happen, and they went into receivership the following morning. It's really sad because SVB is such an important bank for the startup community. It was founded really to provide some of that liquidity to early stage founders and startups that weren't able to get banked by the more traditional banks. So I'm hoping a new bank, or maybe SVB, gets bought and resurrected to provide that valuable service to early stage startups. I'm Greg Raiz. I talk about technology and entrepreneurship. Check out this other video right here. It may be interested for you. Thanks so much. We'll catch you on the next one.